Good morning, everybody. It's 10 o'clock. Welcome to this webinar on share incentive plans. My name is David Pett, and I'll be taking you through the rules, regulations, and the advantages of a share incentive plan as one of the range of tax-favoured schemes provided for in the legislation currently. First of all, an apology. Across the road from our office, a large office block is being demolished, and from time to time you may hear in the background some jackhammering and other noise. I hope that won't disturb the webinar as we go forward. So, to begin with, an overview. What we're going to deal with today is what is known as a SIP, or a share incentive plan. It's governed by the SIP code, that is Schedule 2 to the Income Tax Earnings and Pensions Act, and also other big pieces of legislation contained in the TCGA, Taxation of Chargeable Gains Act, and the Corporation Tax Act. Together, all those provisions that govern share incentive plans are referred to as the SIP code. It's a trust-based plan. You need a trust, the purpose of which is to hold shares on behalf of participants in the plan. And there are different types of awards that can be made under a SIP. Awards in the form of partnership shares, that is, shares which are purchased by an employee or on behalf of an employee out of deductions from gross salary. Matching shares, which can be awarded on a basis of up to 2 for 1, where an employee chooses to purchase partnership shares, and free shares, which, as the name implies, are shares which are gifted to an employee for no consideration. You may also come across the term dividend shares. These are shares which are purchased on behalf of a participant and held in the plan using cash dividends that are paid. There are facilities for cash dividends to be reinvested in additional shares free of tax. They've been around since 2000, and indeed from 1978 we had what were known as profit sharing schemes, which allowed companies to make available to employees free shares, or for employees to purchase free shares with purchase shares and matching shares, but the rules were very different. What we now know as SIPs really originate in legislation first put on the statute book in 2000, and I was part of the government working party that put together that legislation at the same time that we worked on the EMI share option legislation. From 2001 to 2014, they were referred to as approved share incentive plans. But since 2014, the nomenclature has been qualifying Schedule 2 share incentive plans, and you can easily see why they're familiarly referred to as SIPs. Major changes were made to the SIP code in 2013, specifically to make SIPs simpler and more attractive to smaller companies in particular. Until then, they'd been very popular amongst the very large-scale employers. All the big retailers, for example, would be expected to have in place a share incentive plan as well as an all-employee SAYE scheme. But there are a number of pitfalls for smaller companies. Specifically, if the company was the subject of a takeover within 3 years after the shares had first been awarded, there was a risk of clawback charges on amounts which could exceed the amounts on which exemptions from tax were granted at the time the shares were first awarded. And that could prove to be a nasty pill to swallow. So generally speaking, they were little used by smaller companies. That has now changed. In addition, in 2014, the rules were changed so that there was no longer any need for prior HMRC approval of the SIP documentation. That was a very laborious process in which all your SIP documents had to be submitted to the revenue, and it took 6 to 8 weeks for them to trawl through, make comments, as they invariably did, and then give formal approval. That's been replaced by a requirement for online registration of the plan and self-certification that it qualifies by complying with the terms of the SIP code. So since 2015, our experience is that there has been a substantial increase in the number of independent companies establishing a SIP. I'm not able to give you any statistics because HMRC has been unable, because of an inability on their part to process the returns that have been made, to publish the recent statistics. But certainly in our experience, this is probably the scheme which we have put in more of than any other all-employee type schemes. In terms of documentation, and lawyers always like to think in terms of documentation, you need a set of rules governing the SIP, which reflects the requirements of Schedule 2. It's a trust-based scheme, so you need a trust deed. Again, the legislation is prescriptive as to what is to be included in the terms of the trust. It's not a discretionary trust in the sense that its purpose is to hold plan shares on behalf of participants subject to the rules and to acquire and hold shares pending awards to employees. It may also serve as a vehicle for buying back shares from employees who leave, or if under the rules shares are to be forfeited in any circumstances, then typically the shares will fall back into the plan trust. In the case of larger companies, it may also be appropriate to operate alongside the SIP trust a more conventional offshore general employees discretionary employees share trust. The purpose of that would be to warehouse shares pending their sale or transfer to the SIP trust, or their gift to employees as free or matching shares to be held under the terms of the plan. The general trust may also provide a vehicle for buying back shares or receiving forfeited shares. It's not necessary for forfeited shares, for example, to be forfeited to the SIP trust. They could be forfeited back to the general trust. You also need a partnership share agreement if partnership share awards are to be made, and that must include a statutory notice of the effect of the deductions from salary used to buy the shares on an individual's social security benefits. That is a mandatory requirement. In the case of free shares, there still needs to be a free share agreement entered into by the employee to agree to accept an award of free shares upon and subject to the rules of the plan. And then in addition, you will need the record keeping documentation, spreadsheets, and the annual HMRC return template, which for convenience may be filled in as you go through the year. Board minutes and, if required, shareholders' resolutions. Now, some big picture points. First of all, the whole point about a SIP is that the tax treatment of shares acquired by employees under a SIP is extremely generous, far more generous than it is under an SAYE share option scheme or even EMI share options. If the shares are held by or on behalf of the employees in the plan for 5 years, then the shares and the growth in value over that period is entirely free of tax, not just income tax, but also capital gains tax. But the quid pro quo for that is that awards may only ever be made on an all-employee, same terms basis. Note that only employees may participate, so non-executive directors are not eligible. Those among you familiar with ITPA may remember that Section 5 extends all references to employees in the legislation to cover also officers of the company, so directors, company secretaries, and so forth. But that is expressly disapplied in the case of a SIP, as it is for SAYE and EMI share options. There's no eligible activities or trading requirement test, as you have with EMI share options, but the shares must be in an independent company. So note, for example, if you have a property investment company with employees and that company is independently owned, then a SIP could be established, which may offer a very substantial attraction to the shareholders and employees. There's no material interest test, as there is with EMI, CSOP, and SAYE share options. So shares can be awarded to founding employees who already have a 25% plus interest in the company. And since 2013, we can use a special class of employee shares with restrictions attached. And that can prove to be a very valuable tool, as we'll come back to have a look at. It means, for example, that the rules may provide for forfeiture of plan shares if a participant leaves the company for any reason and at any time. So in the case of a small unquoted company where the intention is to work towards an exit event, you could put in place a plan which specifically provides that if any participant leaves the company for any reason, good or bad, before the occurrence of an exit, then those shares are forfeited, or if they were partnership shares, are to be bought back on a no-gain basis. In other words, it's no skin off the nose of the proprietors and the founding shareholders in offering this opportunity to all employees. Whilst there may be tax clawback charges if shares are withdrawn or an employee leaves within 5 years, this expressly does not apply if the company is sold, and SIPP participants can then receive only cash for their plan shares. Remember, that was one of the major changes made in 2013. I think the other change that is the use of standard form documentation. The documentation is fairly long, fairly lengthy, as compared with EMI option documentation, for example. But on the other hand, it is standard form, and that both reduces costs and makes it and ensures that you have a complete code within the documentation, so that it's relatively straightforward for a smaller company to administer. Where a SIPP is in place, HMRC will still agree unquoted share values in advance of awards being made under the plan for the purposes of the plan. Awards and invitations to participate could be on a one-off basis, a one-time only award, or they could be made annually or more frequently, or on an ad hoc basis. Typically, in the case of large employers, they're made on a continuous basis. In other words, employees are offered an opportunity to make deductions from salaries on a continuing rolling monthly basis. And those deductions are then used to buy shares in the company, either at the end of each month, if the company's shares are very liquid and there's a market in the shares, or possibly at the end of an accumulation period, which can be up to 12 months. Then the shares are purchased at the end of that period. But the key point is that whenever an invitation to participate is made, it must be made to all those employees who are eligible to participate. So what's the menu of choice? I mentioned that there are different types of share awards. Partnership shares, these are the shares to be paid for by employees out of gross, i.e. pre-tax salary or bonus. Again, this could be a one-off deduction from salary or bonus in a single PAYE month, or it could be structured as a series of monthly or weekly deductions over a period, and that period is referred to as an accumulation period of up to 12 months. Or again, you could have regular monthly, weekly deductions on a continuous basis with the acquisitions, as I say, made at the end of each month or at the end of each accumulation period. There's a limit of currently £1,800, or if less, 10% of an employee's salary in a given tax year, on the aggregate amount which can be used to acquire partnership shares in a tax year. The plan shares must be acquired using the deductions from salary at their market value. But note that if you have an accumulation period, then the market value, i.e. the price at which the shares are acquired, can be set as the market value at the start of that accumulation period. So in effect, the employee is given an option to acquire shares out of deductions from salary at a price fixed at the start. Alternatively, the company could provide, in relation to a specific award of shares, that the price is to be determined as market value at the time of acquisition of those shares, so that the employee bears the risk of share price fluctuation over the accumulation period, or it could be the lesser of those two. But whichever one you choose, it must be applied on the same basis for all acquisitions of shares made in response to invitations issued on that occasion. Partnership shares cannot be subject to forfeiture, in the sense that if an employee is a bad leaver, he cannot be required to transfer the shares back for no consideration. But since 2013, the Articles of Association could be structured in such a way that there is a requirement for an employee who leaves to sell back his shares on a no-gain basis. So let's just pause to compare partnership shares with an SAYE share option scheme. You could structure it with an accumulation period so that there's in effect a maximum 12-month option. That's compared with the typically 3-year or sometimes 5-year options for a fixed option period under an SAYE scheme. Under a SIP, the exercise price must be equal to the market value, as I've just described. There's no discount as there is with SAYE share options, but remember that because the deductions are from pre-tax gross salary, whereas SAYE deductions are from net salary, then in effect the terms of purchase are more generous. The limit on the value of shares to be acquired is obviously much lower, but the tax treatment is very much more generous. If the shares are held for 5 years, then there's no tax, whereas SAYE share option shares are subject to capital gains tax on sale, subject to the availability of annual reliefs. But also remember that in the case of a SIP, you don't necessarily have the costs of a savings carrier. The deductions can be held by the company, and provided they are in a separate bank account, you don't need to engage the services of a savings carrier or administrative provider. Matching shares. The plan could provide that if an employee chooses to acquire partnership shares out of deductions from salary, then the company may, in addition, offer matching shares on a basis of up to 2 free shares for every 1 partnership shares purchased. In practice, in my experience, awards are not normally so generous. Given the saving to the employer of the employer's national insurance contributions on the amounts used to acquire shares, again, it's no skin off the nose of the employer if shares are offered on a 1 for 10 basis, for example, since the cost of those additional shares is more than matched by the saving in employers' NICs. Matching shares may be at risk of forfeiture if partnership shares are withdrawn or if the employee leaves. And the plan must provide for matching shares to be held within the plan for a compulsory period of anything between 3 and 5 years. It's up to the company to set the holding period, but it must be a minimum of 3 years. Turning then to free shares, of course there's no obligation on a company which establishes a SIP to award free shares if the SIP is used to offer partnership and matching shares. And indeed, some companies operate a SIP on the basis that it is only free shares which are awarded, not partnership or matching shares. There's a limit of £3,600 on the aggregate market value of free shares that may be awarded to an employee in any tax year, and free shares can be subject to forfeiture even if the employee is a good leaver. Typically up until 2013, companies provided, as was allowed by the SIP rules, for a distinction between good and bad leavers, and shares were only forfeited if you're a bad leaver. Now there's flexibility, and in the case of smaller companies, it's more commonplace for shares to be forfeited if the employee leaves for whatever reason. I mentioned dividend shares. The plan rules may allow for the compulsory or voluntary reinvestment at market value of cash dividends paid on plan shares. in the acquisition of additional shares to be held in the plan. Dividends which are reinvested in this way are free of tax. There has to be a fixed 3-year holding period, and if they're withdrawn early, then a tax charge arises. But remember that since 2016, the first £5,000 of personal dividend income is tax-free in any event. And so the opportunity to reinvest dividends tax-free may not be as attractive these days as it was before 2016. I've posed here the question, must all employees be invited to participate? Well, you can impose a qualifying period of employment of up to 18 months, that's up to the date of award of shares. But if you have an accumulation period for savings to be deducted from salary over a period, then the qualifying period must be not more than 6 months, ending with the first deduction that is made. Subject to that, all UK resident employees of a participating company must be invited to participate on a same terms basis. What happens if there's a group of companies? Well, the plan may be established by the holding company and extend participation group-wide. The shares to be used for the plan must be in the group holding company, because you remember that shares must be in an independent company, not a company that's under the control of another company. So it's always the holding company shares that are subject to the plan. The only exception to that is if the company is a subsidiary of a fully listed company, in which case you can use shares in that, but that's quite an unusual situation. A non-listed subsidiary may establish a SIP using shares in the ultimate parent company, which is either for employees of that company only, or which extends participation to employees of it and its own sub-subsidiaries. So you can have a single plan using holding company shares, extending participation to all or some only of group employer companies. But you have to be careful, because restricting participation to some group companies only must not favour directors within the group or those employees receiving the higher or highest levels of remuneration. And I see there's a not missing in that bullet point on that slide. You can have multiple plans, one for each employer subsidiary, on identical terms, perhaps save only for the employer companies to which they extend. I have seen also multiple plans within a group for different employer companies, where for commercial reasons each employer company has wanted to set a different qualifying period in relation to participating employees. If the ultimate parent company is overseas based, then in practice it may be easier to have the UK subsidiary establish the SIP using shares in the overseas parent. In particular, if there is a reluctance to persuade the overseas parent to establish a plan, then it may be necessary to establish a separate plan for each UK subgroup having a distinct UK parent company. In other words, you cannot extend participation in a SIP established by one UK subsidiary using shares in its overseas parent to employees of a subsidiary of a different UK parent company. It's worth noting for those overseas parent companies based in the US that you can use a UK SIP to effectively mirror a US employee stock purchase plan. I said it's a trust-based plan. Who is the SIP trustee? Well, it can be a wholly owned subsidiary formed to act as the sole corporate trustee. It can be individual directors or employees of the company. And in the case of small private companies, that is not uncommon. There is a theoretical risk of individual personal unlimited liability as trustee, but in practice, that's not normally a difficulty or a problem. And for the very small companies, using individual directors, proprietors as the trustees may be the most cost-effective solution. Alternatively, you can use an independent trustee services organisation, but of course they will always want a fee for their services. And note that the trustee must be UK resident, so you cannot use one of the Jersey, Guernsey, offshore-based trustee services company. By contrast with a normal discretionary employees trust, the functions of the SIP trustee are largely custodial and administrative and governed by the plan rules and trustee. The dispositive powers i.e. when and how to make awards, etc., are normally vested in the plan company, so that the trust is more of a purpose trust rather than a discretionary trust. Plan shares, once awarded, are beneficially owned by the individual employee participants, with the bare legal title vested in the SIPP trustee, subject to the rules of the plan. The plan rules normally provide that circulars and notices to shareholders are to be passed on to participants. If the shares carry voting rights, then the trustee may, but is not obliged, to seek directions as to how to cast votes on the shares. But if it chooses not to do so, then it must refrain from voting. In the case of small private companies, it's not unusual to use a class of shares for the purposes of the plan, which are non-voting shares. If there's a rights issue, not in this case extending to an open offer, then the trustee may sell sufficient of the rights to exercise the balance. It's an exercise familiarly known as tail swallowing. And in this event, the new shares are held as plan shares. They're treated as acquired when the original plan shares were acquired and awarded. If on the rights issue new money is used to take up the rights, then those rights issue shares are not held within the plan. To qualify for the tax advantages as a qualifying plan, it must be registered with HMRC through the PAYE online portal. Registration is best done before the first awards are made, just to ensure that nobody forgets to do so, but it must in any event be done by 6th July in the next tax year after the first awards are made. Note the registration includes a declaration by the director or company secretary making the registration. It includes a declaration that the plan complies with all relevant requirements of the SIPP code, and no doubt that individual will in turn look to the company's advisors for confirmation that that is the case. In addition, there are annual year-end online returns to be made to HMRC, again to be made by 6th July the following tax year, and these include fresh declarations and details of all awards and events relating to SIPP shares in that year. As I said earlier, the Revenue publishes a worksheet which is in a form that enables you to enter details in the prescribed manner as you go, so that when you come to make your annual return, you should have the template already completed. The Revenue has wide powers of inquiry and to levy penalties if a plan is found not to satisfy the requirements or not to be properly administered, or if there is a disqualifying event. Now, I've mentioned that there's very generous tax treatment for SIPP shares. There's no tax payable upon an award or acquisition of plan shares, free or partnership and matching shares. If shares are held in the plan for 5 years, then there is no income tax or capital gains tax when the shares are sold out of the plan. The benefit of having acquired and sold the shares is entirely free of tax. And unlike an SAYE option scheme, where the option is for a finite period, under a SIPP, the shares can be held in the plan for so long as the employee remains employed with the company or the group. And for so long as they are in the plan, any growth in value is free of capital gains tax. If a participant leaves, then his or her plan shares immediately cease to be held in the plan. No tax is then payable if a participant leaves for a good reason, injury, disability, redundancy, 2P transfer, the employer's company ceasing to be an associated company, retirement or death. No tax is payable if at any time the shares cease to be held in the plan because of a takeover of the company, in circumstances where the plan shares can then only be sold for cash. If partnership shares otherwise cease to be held in the plan within 3 years of acquisition, typically because the employee chooses to withdraw them in order to sell them, then income tax, and if the shares are readily convertible assets, national insurance contributions may be due on their market value at the time they're withdrawn from the plan. Curiously, if the participant is then obliged by the Articles of Association to offer them back for sale, then tax is only due on the lesser of the partnership share money used to acquire them and their market value at exit. So in other words, and this is by reason of faulty legislation, by including in the Articles of Association a requirement for the shares to be offered back for sale, it is possible to ameliorate the or reduce substantially the amount on which tax may be payable if shares are withdrawn early. If partnership shares otherwise cease to be held in the plan between 3 and 5 years after acquisition, tax and, if applicable, NICs are due on the money used to acquire them or their market value at exit. In other words, there's a tax charge, but it's not a penal tax charge. If free or matching shares otherwise cease to be held in the plan within 3 years of acquisition, then tax and NICs are due on the market value at the exit date, subject to that point I made about the curiosity in the legislation, allowing for a more favourable treatment if there's an obligation to offer shares back for sale. If free or matching shares otherwise cease to be held in the plan between 3 and 5 years after acquisition, then tax and NICs are due on the lesser of their market value at the award date and their market value at exit. Income tax is also due on any capital receipt which may be received in connection with the plan shares. That could be, for example, a sale of rights issue under where the rights are sold for cash with no tail swallowing. If the shares are readily convertible assets, then any income tax due must be accounted for under PAYE. The trust deed will allow for the SIP trustee to sell sufficient shares to fund the tax and to pass the proceeds to the employer company to be put through the payroll. If at that time there's no such company in existence or HMRC agree that it's impractical to do so, only then will the SIP trustee itself need to operate the PAYE. Normally it's operated by the company through its own payroll. Likewise, any cash sale proceeds or capital receipt on which tax is due must be paid to the employer for it to be put through the payroll and for PAYE to be deducted. An obligation to account for tax under PAYE also arises whether or not the shares are readily convertible assets. If, for example, partnership share money which has been deducted is returned before the shares are sold, perhaps because the employee leaves partway through an accumulation period. And it's worth noting in the case of smaller companies that if the shares are not otherwise readily convertible assets, simply setting up a SIP and operating it will not of itself cause them to become readily convertible assets and so trigger liabilities to NICs and obligations under PAYE. Corporation tax relief is available for the cost of setting up a SIP and also for the cost of contributions made to fund the acquisition or subscription of shares to be awarded as free or matching shares. But the relief is for the market value of the shares acquired at the time of acquisition, albeit that it's only given in the period in which the shares are actually awarded, and that typically reflects the accounting treatment. If shares, having been first awarded, are then forfeited, no further CT deduction is allowed for recycling them again. In other words, you can't keep recycling the shares and claiming a fresh CT deduction for them. If during an accumulation period the market value increases, and because the price at which partnership shares are to be acquired was fixed at the outset of the period, remember the points I made back on slide 8, and in consequence the company has to make a contribution to top up the partnership share money deducted in order to buy the shares, then corporation tax relief is given for that contribution. But note that it's not given if a top-up is required because the share price has fallen. Broadly, if there's a CGT rollover of plan shares, then the new shares will remain held in the plan and stand in the shoes of the shares originally acquired or awarded. And this is so whether or not the new holding would qualify to be acquired or awarded under a SIP, because by that time there are shares in what has become a subsidiary company. So on a takeover of the plan company, the company whose shares are held in the plan, the offer might be on terms that participants can sell some of their plan shares for cash only and exchange other plan shares for loan notes, which, if held in the plan until the end of the 5-year period, may be repaid free of tax. But beware, it is plan shares sold early on a takeover for cash only, which are free of tax. If the offer was structured as an offer to buy plan shares for consideration, which in the case of each share is part cash, part loan notes, the cash exemption from the clawback charge will not then apply. What about the tax treatment of the trustee itself? Well, if the trustee holds unawarded shares, then provided they're awarded within a given period, the trustee is not liable to tax on dividend income and is exempt from capital gains tax on an award of the shares or disposal when it sells them as partnership shares or awards them as free shares. And that period is 2 years if the shares are readily convertible assets, or 5 years if they are not. Now, there's also some little known extra tax reliefs available for a planned company in certain situations, and this arises from a private member's bill that was put through Parliament in 2002, and it introduced an additional corporation tax relief for a company if it makes a payment to a share incentive plan to allow the SIPP trust to acquire at least a 10% shareholding from individuals or trustees. The relief is withdrawn if 30% of those shares are not then awarded under the SIPP within 5 years and/or all of the shares are not awarded within 10 years. But note, if the relief is withdrawn because you haven't been able to pass out all the shares purchased within those periods, there's no penalty. The company would have had the cash flow benefit of the deferral of tax, and if the shares are subsequently awarded, then relief is once again allowed. But since this is a useful way of extracting funds from a company, owners, proprietors, to dispose of shares at the expense of the company, you will note that there will normally be a need for a clearance under the Transactions in Securities Rules under Section 701 of the Income Tax Act 2007. There's also, under this body of legislation, yet another relief available to the vendors. If the vendors of shares, which together make up the 10% holding, sell to the SIPP trust, then they can roll over any capital gain into any other chargeable assets. The only exceptions are own houses or EIS shares, provided the new assets are acquired within 6 months from when the SIPP trust first acquires its 10% holding. Participants, one point made against SIPPs is that for a lot of employees, particularly the lower earning employees, there is a risk attached with putting all your eggs in one basket and having assets invested in shares in your employer company. If the company goes under, not only do you lose your job, but you also lose the value of your savings. There is opportunity for diversifying out of the share incentive plan. After the 5-year period, a participant can transfer his plan shares, subject to limits, into an ISA or into a registered pension plan. And those, of course, will allow him to retain the benefit of the tax-free wrapper. Sadly, in practice, insurance companies and pension funds have been very slow to put in place the administrative processes to allow such transfers to be made easily. So let's have a look at an example of the use of a SIPP in a private company. Let's assume the company is working towards an exit event and that the intention is to allow all existing employees to benefit only at that time from owning shares in the company. It allows them each to have the benefit of a slice of the cake when the cake is sold. So existing shareholders might resolve to create a new class of non-voting B shares, which rank equally with ordinary shares, save perhaps for not being entitled to dividends, and save possibly for the transfer provisions relating to those shares. There would be restrictions on the transfer of B shares and provisions for the sale back of those shares when an employee leaves. The SIPP trustee is funded by a small CT deductible contribution to enable it to subscribe for B shares at par to be awarded as free or matching shares in addition to partnership shares. Free shares are then awarded to all qualifying employees and/or all those employees are invited to buy partnership shares, possibly with the lure of a matching share. And the SIPP rules could provide for forfeiture of free B shares if the employee leaves before an exit event for any reason, unless possibly the employee is a very good lever when they may be allowed to keep them outside of the plan, perhaps for a limited period. And the rules might also provide that an employee who leaves holding partnership shares, those are the ones he's paid for, must offer them back for sale to the trustee on a no-gain basis if he or she leaves before the exit event. And remember that in an unquoted company, the market value, as agreed with HMRC at the time the awards are made, may be set at a discount of up to 75 or even 80% of the pro rata value of a share. So if you couple that with the fact that the purchase is made out of pre-tax salary and the uplift, the pro rata value on a sale of the company, then an initial purchase of £1,800 worth of shares could, in the event, prove to provide an extremely valuable nest egg. So, against that background, I do hope that you now have an understanding of how a SIPP can allow any independent company, including even, say, a closely held investment company, to enable its employees to benefit through share acquisition in a manner which affords very generous tax reliefs and exemptions. By using standard form documentation, SIPP shares can be awarded relatively quickly and cost effectively. Ongoing administration is, in my experience, relatively straightforward, and in any event, help is always available to you. Now, there is an opportunity for questions at the end, and if anybody has any questions, then we can have a look and see if we can answer those. I don't think we have any questions at the moment. We have one question here from Sarah at Tapestry, asking about bonus sacrifice in return for free shares is acceptable under the SIPP legislation. Sarah points out quite rightly that a SIPP must not provide cash to employees as an alternative to shares, but it was understood that the reverse was acceptable. In other words, that SIPP shares can be made available as an alternative for cash. In my experience, there is no reason why, having made an offer of free shares and having identified those employees who have chosen not to take it up, the company cannot, in its discretion, subsequently award a cash bonus to employees. The difficulty lies in a company making clear at the outset that you have a choice of receiving either cash or free shares. Now, some on the call may know, as I do, that there is one very large company which has managed to operate its scheme on that basis, one of the large retailers, and it's always been a bit of a mystery to me as to why HMRC have chosen to accept that. I think, though, the rule must be taken to be that you cannot invite an employee to elect to take either cash or shares. But as I say, if having taken free shares, the company then decides that other employees are deserving of a discretionary cash bonus, I don't see that there's any reason why that should be struck down. I'm not aware of any other questions. If anybody does have any further questions, please feel free to email me, and we will try and answer them for you. I hope you've all found that webinar worthwhile, and since it's now almost exactly 10:45, we will finish there. Thank you very much for attending and for your attention. Have a good day. Bye-bye.